Okay, what we have here today is a couple of indicators I've developed to try and get people to move away from basically stuff which doesn't work, like technical indicators. There is real statistical and engineering methods which work without relying on technical indicators. They're just well-worn old workhorses. What they actually are is anomalies, arithmetical anomalies that found an edge in the market or an arbitrage. There was actually no correlation to economics or any of the factors they claim. All their methods, like for RSI and Bollinger Bands, everything, it's all post-ergo prop hoc logic. It happened after the event and was retrofitted. They just stumbled upon the stuff and hoped for the best, and it made money for a while. Now, you can make money with it in incredibly small time frames. Sometimes it persists for a week, but not long. Only because the market isn't efficient. Not because it is efficient, but because the market has a certain efficiency or a large amount of noise, actually. The arbitrage pricing theorem is the actual market. Forget about the capital asset pricing theorem. It's not efficient. Because of the arbitrage pricing theorem, technical traders, once a technical method works, everyone knows it's so well exposed that it only works for a few hours or a few days because everyone else starts getting onto it until, by the arbitrage, once an arbitrage is known, it's traded out of the system by the fact that everyone knows it. Now, this is a reliability indicator that comes from engineering. It's an exponential reliability indicator which indicates the stress in a system. Now, that is the daily log returns of prices, and that indicates from May till October this year. Whoops. Oh, come on. That shows from May till October this year the peaks in stress in the indicators. Now, ironically, it's showing peaks in stress not when the market is downturning, but when it's at a high. So, it shows that generally before a high there is a big downturn, as you can see. Or at a high, at a peak, there is a downturn. And this is another indicator that comes from engineering, which I developed this years ago and I've revisited it. It is a TRIX tracking index. Now, the trend indicator is these little bars here, this little bar chart. Now, from 1 to -1 indicates complete randomness. There is no pattern or trend inherent. From 1 upwards, there is a tendency in the data, or what I've labelled here short-term trend. To actually, like technical analysts, when they say there's a trend, don't mean a true statistical trend. A true statistical trend would need an upward or downward swing for at least 100 or more days continuously. Give or take a few ups or downs, but nearly a continuous up or down swing. This is 100 days, and the stock market rarely exhibits upswings or downswings like that. It suffers from geometric Brownian motion, and it oscillates around ups and downs because the noise in the traders. It's not efficiency. It's just that traders are noisy and unpredictable. Noisy in the engineering term of, there's a signal. Assume that the forecast is a signal matching the actual price, and around that signal is the noise. That's mostly noise. There it's a definite downtrend, and there it's a definite uptrend, and there it's reached an uptrend, but like for only a couple of days, and once again maybe a week. Maybe a week there. Most of the time it just oscillates around unpredictability. Now I trade on that. I trade on stochastic arbitrage, or volatility arbitrage as it's known. Volatility mean regresses. Prices don't. They're auto-regressive. A down is more likely to be followed by a down for a while. An up is more likely to be followed by an up for a while. But not continuously. That's the point. Not enough to make a profit continuously out of it. And here's another chart, which is just a simple... Most people, when they measure their profits and ROI, do not measure it on cumulative returns. You can see if you started on the 10th of May when I started to track, up until about, probably about July, you would have had a negative 4% return. Then the market bolted up. You can see there. And you would have had a cumulative return of around 6%, so on and so on. It rounded out in October to a return of about 4%. A cumulative return is it's not the compound returns, it's a daily summed returns from start to finish. It's not a daily return, as in that. That is a daily return. This is a cumulative daily return. It's a fine line. Now that's all I wanted to say. There's a histogram in the data here. That's neither here nor there. I won't go into how it's derived. I'd have to make a 45-minute video. You can see it's a table and there's lots of stuff here. Various things. And here, I think the data must be hidden somewhere. Where's the data? Oh, that's the chart again. Short-term trend indicator, stress indicator, cumulative returns per 100 days, histogram of days. So I've duplicated the chart. Anyway, this is what can be done. And hopefully if I get enough time, so I haven't got much time, I've only got about 3 hours a day at best, not every day, to develop on things and produce videos and get this done. I've got a backlog of stuff. My Patreon account has nothing because I'm continually developing, and to get the stuff in a presentable format, even these videos, my videos are shoddy because it takes so long to present them on your own. Anyway, I try my best. Hopefully I'll get it on Patreon sometime. You can read the paper and figure it out for yourself. I'm not going to make an hour video describing it in detail. It's really boring, those videos. They are for me. Some people have a lot of patience and can wade through them. Alright, well I'll stop there. Thanks.